Wedbush upgrading Lennar from underperform to neutral today. The note citing the stock price moving through $144. That's the price target that had been in place from Wedbush. And we've got the analyst behind that note, Jay McCandless, who's joining us now, Wedbush Securities Senior Vice President of Equity Research. Jay, it's good to see you here. So you're not saying everything is fantastic for Lennar. It's basically that maybe it is now pricing in a little more realism, perhaps, for the outlook?
Yep. Thanks, Fabian. I think that's well said. We think the entry-level buyer, not just for Lennar, but also for Horton, LGI, and Meritage, where we're still underperform rated, that buyer's having a real struggle with affordability. The builders are trying to bring prices down, provide more incentives to make these homes more affordable. But right now, like you say, the stocks have certainly priced in, I think, a rougher environment in the back half of the year. But for some of these names, we still think there's some downside. But Lennar moved through our target. And we also, what we talk in the note is they've announced publicly that at some point they're going to be spinning off some of their land assets. I do think that could be a positive catalyst for the stock. And timing has not been announced by Lennar, but we just wanted to highlight it as a risk to people who might be on the short side of this trade.
And you did talk about that, Jay, this potential catalyst, the land spinoff. And as you noted, company isn't offering details, but what could that potentially mean for Lennar?
So theoretically what Landspin, and that's our name, not theirs, what Landspin would do is create a just-in-time lot factory for Lennar. When they have a buyer, when they want to start a spec home, they could essentially order a finished lot ready to go. And that would allow Lennar to focus on what it does very well, which is build homes, and allow other outside entities to focus on the land development side. And as land development has just as many challenges, I would say, as actually getting the homes built.
Is this a model we have seen the other home builders employ successfully?
Yeah, D.R. Horton owns a majority stake in a company we do not cover called Forestar. Forestar performs kind of those same functions for D.R. Horton now. And it wouldn't surprise me in the future if some of the other builders decided to go this route, because what we have seen is that the larger builders want to have more of what we call option lots rather than owned lots on their balance sheet. They believe and have demonstrated, I think, in the past that having less owned land on the balance sheet improves returns on equity.
Jay, just look at your coverage universe, neutral Lennar, neutral Pulte, neutral KB Home, underperformed D.R. Horton. In broad strokes, Jay, why the kind of skepticism still about the sector?
Yeah, I think it's the affordability challenge I mentioned earlier, but also we've called out the fact that new home inventories are at multi-year highs now. It feels to us like the builders may have started a few too many specs at the beginning of the year when most people thought mortgage rates were going to be going a lot lower than the 7 and change where we're sitting today. So I think it's a combination of a little too much supply on the market, and again, the affordability being stretched. And I would say also in terms of what the street is expecting for gross margins, it just feels like to us consensus estimates are still too high for especially some of these entry-level builders that were underperform rated on. There seems to be a lot of competitive discounting in the field, and the builders are starting to throw in add-ons we haven't seen in a long time, like putting blinds in the house, furnishing the full suite of appliances, et cetera. So lots of those things, and including mortgage rate buy downs, we think are going to be gross margin negative and might push consensus estimates lower.
Jay, and there had been some talk about maybe some of the builders backing off of those a little bit, but it sounds like you don't see that's happening.
No, I think with 7% plus mortgage rates, again, with I think a little bit of maybe a little extra too much supply in the field, it doesn't feel to us, and we try to take a look at as many of the online promotions that our builders publish. If anything, it seems like the intensity and maybe the dollars involved in those promotions have moved up a little bit, especially in the last 30 to 45 days. So it may slow down at some point once they've moved through some of this inventory. But at this point, it doesn't seem like it's slowed.
Jay, so you got plenty of skepticism about names in your coverage universe, but give us one you like, Jay. What do you tell clients is a buy here?
Yeah, Builders First Source is a product name. The ticker's BLDR. That's a name that if we were to see a pullback in mortgage rates or something else that turns sentiment positive on single family construction, that's 75% of their business is single family, and we think the purest play that we have on construction right now. So we'd highlight that one on the product side, and then we do have one small cap builder where we have an outperform rating. That company's Landsea, the ticker's LSEA, and we feel like at roughly 50% of book value now that's way too cheap for that stock. The builder focuses on mainly on Florida and Texas right now, and also has some California exposure.
Jay, always good to have you on the show, my friend. Thanks for joining.
Thank you.